Hello student, how are you? In last lecture of capital theory structure, we discussed about the relevance approach of capital structure theory. Now we are going to discuss about the irrelevance approach. Now in relevance approach, what they assume is like when you make any change in capital structure, that is either you increase or decrease equity or debt, it has directly relation with the value of the firm and the WACC. We have seen this in net income approach and the traditional approach. Now, in market there is also the another approaches. That is we call it as a irrelevance approaches. Now, what they assume is that value of the firm has nothing to do with the change in the capital mix or capital structure. Means either you increase the equity or debt or decrease equity or debt, there is no impact on the value of the firm. So that is called is a irrelevance theory approach. This theory is developed by Modigliani and Miller. So we call it is a approach. So here we are having two proposition. So let us discuss the same. Now, for hypothesis or Modigliani and Miller, we are having some assumptions. So that assumptions are the same that what we discussed in the last lecture. That is the 7 assumptions. Means there is only equity and debt. There is no change in capital structure. There is no personal and corporate tax. So these are some assumption. Dividend payout ratio is 100%, so that remains same. Now this is Modigliani and Miller. They argued that is the perfect capital market. In perfect capital market, without taxes and transaction cost, the value of the firm depends on the earning and risk of the assets rather than the capital structure. Now what does it mean? It means if company is earning sufficiently with a calculated risk or given risk, the value of the firm depend on the earning and the risk, not on the capital structure. So they explain very nicely, and that is they give a two proposition, that is proposition 1 and proposition 2. Now again, how to remember this? So again you can focus on the figure. Like this is a figure of hypothesis. If you remember, this was the for a net income approach, then this was the for traditional approach, and now this is for a approach. So now what they say is in proposition 1 that, for example, there are two companies. Okay, I keep it like this so it will be very easy for you. Okay, so suppose there are two companies. Now these two companies are equal in all the terms. That is in terms of investment, risk, earning capacity, business, product and industry. Means these two companies are having all the factors, that is earning and risk are the same, and they are selling the similar kind of product, and both the companies are generating revenue of rupees 50 crore on a total investment of 200 crores. It means they are able to generate 50 crore on an investment of 200 crore in total assets. And if the opportunity cost of capital of the firm is 20%, means both the firm, in that case the value of the firm, that you remember the equation, that is earning before interest and tax divided by WACC. So here the opportunity cost of capital is nothing but the WACC. So that comes to 50 crore divided by 0.20. So value of the firm comes to 250 crore. Now if you see that this 50 crore income has nothing to do with your capital structure, that is your interest and the cost of equity and cost of debt. Now see, that is what we discuss in the net income approach. If you remember, if you see that here the sales, then we deduct variable costs, we got a contribution, we deduct fixed costs, we got earning before interest and tax. Now see, up to this earning before interest and tax has nothing to do with your capital structure. So either you have a 100% equity or a 90% equity or 100%, 10% equity or 100% debt or 50% debt, your earning is going to remain same. So what this approach is telling, that is hypothesis is telling, that when the value of the company is depend on the company's earning capacity and market expected return, that is opportunity cost of capital of the firm. So the value of the firm has nothing to do with the capital structure. So now we easily interpret this thing, that when the company is having 100% equity or only 10% equity and 90% debt, the earning remain as it is. And the second thing what they assume is the opportunity cost of capital, like in this case is a 20%. It is a something that the company is having. So the value of the firm easily can calculate with net operating income divided by firm's opportunity cost of capital. So now if you see over there, so this is a leverage. So what this says is either you have a zero debt or you increase the debt, your weighted average cost of capital, that is KO, is equal to your opportunity cost of capital. So they assume that the opportunity cost of capital remains same. Now the KE and KD, like the question can be that what we discuss in a traditional approach, when you increase the equity, when you increase the debt, the cost of equity and debt both is increase. Yes. So now the question can be that, so like a company go for a 10% debt or 50% debt or 100% debt, then definitely there will be the change in cost of equity and cost of debt. Now what they assume that the WACC is remains same, and the KE and KD adjust accordingly, so that all the firm offer WAC equal to WACC return. Now suppose this is not the case, like suppose someone can argue that a company is having higher the debt, but obvious it is offer a higher risk, and but obvious the return should be offer a higher. Now suppose the case, so now if any of the company offer different return, then arbitrage opportunity will arise, and finally both company will offer the same return. Now let us understand this with a equation. For example, in a last previously discussed, suppose two company having the same product, same business, same risk, but one company offer 12% return and another company offer 15% return. Now see, in that case, what will happen is any investor who is sound enough definitely will invest in a company which offer a higher return, that is 15%. Now here what will happen is the majority investment will divert to the company which offer higher return, that is 15%, and the person who already had invested in a company which offer 12%, that is lower return, they will shift their investment from 12% return company to the 15% return company. Now this shifting or the change in the investment in the share of 15% return company, what will happen is the demand of this company, that is 15% return company, will increase, and the price or share price will go up and they become a costly. So finally what happened is, earlier you were supposed to earn 15% on 100 rupees share, for example. Now the 15 rupees that you will earn on the price of 120 or 150. So if you calculate the proportionate return, it will go down, because earlier you were earning 15 rupees on 100 rupees investment. Now the same 15 rupees you will earn on an investment of 150 rupees. So but obvious their price of the share will go up, and the company which the people were selling the share, means who already had investment, they will sell the share of this company which offer a lower return. So the price of this share will go down and they are available at cheaper rate. Now for example, the price of the share were 100, on which it will offer 12 rupees as a return, so 12% was the return. But as people will sell the share of this company, the price of the share comes to suppose 80 rupees. So earlier you were earning 12 rupees on a 100 investment, but now you are earning 12 rupees on an investment of 80 rupees. So but obvious you will earn a higher return. Now this process will continue, and it will continue up to that at the end both will offer a same return. Okay, so this is known as a arbitrage thing, where if this condition is not satisfied, means suppose one company is having a higher return or different opportunity cost of capital, but obvious the investment will change from a lower investment to higher investment, and it is going to remain the same, that is same WACC or opportunity cost of capital. So this is about proposition 1. Now come to the proposition 2 and the last part of this. Here again you have to remember this figure. You see that cost of debt remain stable for a while, and then it will start to rise. Similar way cost of equity rise with the increase in the debt, and after that it start to fall. But you see that your WACC remains stable. So again is stick to their assumption that whatever may be the value of the firm has nothing to do with your change in capital mix. Now how and what is this graph or figure is telling us? Now see, if you assume that financial leverage impact on cost of equity and cost of debt, like suppose someone can doubt, if company increase the debt, definitely cost of equity will also increase and cost of debt will also increase. But you see that after certain level, for example, when debt increase to 100%, so but obvious cost of debt increase to 90%. So but obvious now equity left is only 10%. And earlier whatever may be the risk was faced by the equity shareholder now will be faced by the cost of that is debt holder. So now in that case what will happen is the cost of debt will start to rise, and it times comes when they will ask equal to the return which is offered to cost of equity, means KD becomes equal to KE. And the reverse what happen is the KE which are only 10% left, now the risk is already transferred to cost of debt. So definitely they are facing less risk, so they will have a lower return. Okay, so this is what this chart is telling about. So now if we assume that financial leverage impact on KE and KD, but in long term KE will start to decrease as increase in debt will transfer risk of equity to debt holder. So change in capital structure will not have any impact on KO and value of the firm. Means what they are telling is this KO remains same, and accordingly the KE and KD is supposed to be adjusted. So this is your proposition 2, and that's all for this capital structure. You have to solve example, that is number 1, 2 and 3, and that is suffice for this chapter. I hope this will solve your query and doubts for this chapter. Wish you all the best. For any queries you can message me or call me. Wish you all the best.